Let me bring to the show Mark Ostwald, Chief Economist and Global Strategist, ADM Investor Services. Good morning, Mark, and thank you so much for joining us as always.
Good morning.
So, Mark, of course, I'd like to hear your take on the retail sales. We do see pretty numbers, by the way, well above expectations, both on an annual basis and, of course, month on month. So what's your first take on the data?
Clearly a lot better than expected. The strength was broad-based. Other than clothing, there was strength in autos, strength in gasoline sales. Both of those, obviously, one has to treat with a pinch of salt because there's a lot of contribution there from price increases. Always a reminder that retail sales in the United States are a value, not a volume number. So one has to adjust those. But you've got things like building materials, household equipment, all posting strong gains. So the consumer is pretty much alive and kicking in the States, despite the higher level of inflation, which is obviously pinching a little bit. There's some good underlying strength there. This obviously won't look quite so good when we have a look at it in terms of private consumption contribution to GDP, because that is adjusted obviously for inflation. But nevertheless, volumes are holding up very well.
On the other side, we also get some interesting numbers when it comes to the import prices, month on month 1.2% higher compared to 1% expectations, and also export prices month on month 1.5 versus 0.9% expectations. So what are these numbers suggesting in your opinion?
Again, the headline import prices basically all of telling us all about energy prices. The ex-energy prices still sort of telling us that the price pressures that you've got in the States are not only domestically generated, but they're also externally generated, and that's despite the strength of the dollar. Though that said, obviously the dollar's not particularly strong against the Chinese yuan, from where the US gets a lot of its goods imports. So again, a little bit of an offset there.
Mark, before we move, of course, to use stock market, I was wondering, after the data that we saw today, of course, from the UK, I'm talking about a payrolls, we do see very nice reaction of the sterling against the dollar. Do you think that a rate hike is imminent at this point?
Certainly the banks, in its very bad messaging, one would have to add, has made it fairly clear that one of the things it really wanted to wait for when it decided not to go this month was to see how the labour market panned out. And so on the basis of that data, basically a strong rise, increase in the HMRC payrolls number, which is slightly more timely given that it's for October. A lot of the data is that we got today is actually still within the furlough scheme period, i.e. to the end of September. There shouldn't be really too much holding them back now, particularly much depending on what we get with the CPI data, which everyone's expecting to be strong tomorrow, particularly a big contribution from household energy prices as that price cap was lifted, and obviously petrol prices. And on Friday, I think that the bank's other point of concern is that consumer spending hasn't been that strong. Obviously, you have to be a little bit careful with that because the retail sales numbers really only tell you about goods spending. And it's quite clear if one looks around London or any of the other major cities in the UK, that's what's going on is a little bit of a switch from goods spending to services spending, i.e. on leisure and hospitality. So the retail sales numbers on Friday, which are very volatile in any case as a series, probably won't give us the complete picture of what's actually going on in terms of consumer spending. But for the time being, they might as well get on with it. The real challenge for the Bank of England, though, is getting hold of their messaging, because there is a danger that they go in December and the market keeps on pricing in more and more in the way of rate hikes, and that they are not looking to be aggressive. That it's clearly not what they're trying to tell us, even though their messaging is very confused. And the bank really needs to get hold of this whole signalling on what the rate trajectory is going to be. That's the key point.
Mark, I was wondering, when it comes to labor shortage, we're still talking about United Kingdom. How much of an issue is this, in your opinion?
It's a very substantial issue. Now, there are two different issues here. There is a Brexit-related issue, but that's not the whole issue. A lot of it is actually to do with skills shortages. There's a big skills mismatch in terms of what's available in terms of labour. Some of that obviously could be filled by EU workers, and there's no question about it. But that's not really that's not the only issue. Basically, there needs to be some sort of transformation in the UK, particularly post-Brexit, and with less EU workers available to fill in any skills gaps that there are. And it's something which needs to be addressed by the government. And to my way of thinking, there's nothing in the budget which will actually do that. So it could be actually quite a headwind going forward.
So I just wanted to move very quickly once again to the United States. We have a pretty interesting meeting between President Biden and Xi Jinping, considering the inflationary pressures to the upside and also commodity prices, which are continuously surging, specifically compared to the 1 year ago prices. I was wondering, do you think that Biden could be more friendly in terms of tariffs to China? Tariffs on China, sorry.
Being more friendly to China really isn't going to solve a lot of the problems. This is to do with supply chain bottlenecks and having a more cozy relationship or a less fraught relationship with China. And I would remind everybody, as always, this isn't just about President Biden. This is actually about Congress, which is fundamentally hostile towards China on both sides of the House, Republicans and Democrats. But it isn't going to resolve any of the supply chain bottlenecks. They are things which will take time to resolve. Just actually, as with the oil prices, trying to bully or goad or cajole OPEC Plus into more oil, into producing more oil, isn't going to solve the problem either. What you've got to understand in terms of a lot of the oil price problems that they've got in the United States is it's to do with lost production capacity, i.e. refining capacity. It's about product, not about crude. So, all of these things, being nice to President Xi isn't actually going to solve the fact that there are 82 ships sitting outside of the port of Los Angeles at the moment. It just really isn't going to make any difference whatsoever.
Final take, Mark. In your opinion, what's the major risk for markets from now on?
I think the major risk from markets is at some point the Fed throws the towel in, i.e. it starts to signal it will, it is looking at maybe the middle of next year for a rate hike. I think at the moment, still the majority of the Fed are looking at the earliest at Q4. Now, if we bring that forward, then we could actually start to see credit spreads widening quite a lot. And the equity market, if it starts to see credit spreads widening, particularly high yield credit spreads, will take that quite adversely and take it as a signal that the very benign financial conditions which has existed for a very, very long time, even with the brief intermittent sort of hiccup that we had in 2018, 2019, are perhaps actually coming to an end, and people need to be basically looking at reshaping some of their portfolios to be slightly less risk hungry.
So do you think that the Fed is behind the curve, as Mohamed El-Erian is saying pretty often publicly?
Yes, I think they're very much behind the curve, and I think actually pretty much all the central banks are going to find themselves in that situation. There are differences, obviously. I think the Bank of England and the Fed have a more pressing need to tighten policy, whereas the ECB and the Bank of Japan do have many more structural deflationary pressures built into their economies, which aren't going to go away in any great hurry. But in all cases, this loose monetary policy that we've had, which has fueled a lot of the asset price inflation, i.e. above all equity markets and housing markets, is something which they need to basically start to rein in. And they probably need to rein it in rather more aggressively. Their only problem now is having injected so much liquidity into financial markets, that liquidity now becomes a loose cannon.
Thank you very much. Mark Ostwald, Chief Economist and Global Strategist, ADM Investor Services. Have a great day, Mark.